No. Now see, this is probably the only topic in corporate finance where if you have some maths, it might be helpful. Okay, not required. It's not mandatory. But if you're good at maths, you'd probably be able to crack this thing very, very fast. Okay. And my general observation is that this is where people generally have difficulty with this topic. Though it's really easy, it's only common sense. But the reason why people have difficulty is because they do not generally calculate very easily one simple number which is called as weighted average. Okay. So the way I thought I'll do it first this time around is that we will first learn what weighted average is, so that when we actually start calculations on cost of capital, it would make your life easy. Okay. So this is common sense. See now that let's say we have three observations. Okay, so we have this three students, A, B, C, and this is our sample out of, let's say, 100 students batch, and we have their marks. Okay. So how much marks? Let's say this gentleman has scored 50, B has scored 60, and C has scored 70. Now what we want to do is we want to take an arithmetic average of these three. Okay. Arithmetic average, or we at times we call this a simple mean. So if I have to take mean, that my mean would be 50 plus 60 plus 70 divided by 3, which would be 60. Okay. So when I take an arithmetic mean, what I actually mean, what is the true meaning of this is that to each of the observation I am giving equal weight. Okay. So what it means is, since there are three observations, out of 100 if I am giving equal weight, I am actually giving weight of 33.33%, 33.33% and 33.33% to all of the observations. So instead of taking arithmetic mean, now if you just use these weights, so how do you calculate mean is, if you want to not do it this way but using percentage, multiply 50 into 33.33%. How much? 16.66. 16.66. Multiply 60 with 33.33% and multiply 70 with 33.33%. And then take a total of all of these, it would be 60. So what it means is that an arithmetic mean can also be a weighted average mean if the weights are exactly same. Or that's what actually arithmetic mean really is, that you give an equal weight to all of your variables or all of your samples here. Are you clear with this logic? So how do we calculate weighted mean? We have marks, we multiply that with the given weight. We have to make sure that the weight of all the variables has to be 100%, and then you get your weighted average. Now I'll give you a few, now let's assume a scenario that we have taken sample of 100, and what we feel is that almost 90% of my students are more or less like A. Okay, so B and C are probably exceptional category of students. So now what I want to do is, I want to calculate a weighted average, but I want to give this guy a weight of 60%, and I want to give B and C a weight of only 20% and 20%. So now to calculate a weighted average, what we would be doing is that this 50 is more important for us. So 50 into 60%, this would be 30. 60 into 20%, this would be 12. And 70 into 20%, this would be 14. And then take a total of all of that. So 52, 56, total is, I've done a mistake. It should be 56. Are we clear with the logic? And again, it is relatively lesser than your arithmetic mean. And this makes sense because you've given higher weight to student A who scored lower marks. So your mean is being pulled down. Are you clear? So this is how you would calculate weighted average mean. You would find out the individual values and then you would multiply with their respective weights. Are we good with this? Now why do we need this? Let's say we have a company here. We'll make a balance sheet for this organization. Okay. And this organization has got total capital of 1000. It has got total assets of 1000. This capital is made of three parts. They have equity here. This equity is 200. They have preferential capital here. this preference share capital is 200, and they have this debt, or they have loan, which is 600. So that's how their total capital is 1000. Now let us start from debt. That this debt will have a specific cost which is given to us by the bank. Right? The bank will tell us that if you take this loan, on this loan you will have to pay interest of 10%, 15%, 18%. So that's the cost of this money, 600. So let's say that I am assuming that this cost is given as 10%. Okay. Now what calculations we are doing as of now, these are not perfectly correct, and later on we'll be refining them. But as of now we are doing it just to understand and have a broad level of understanding. Will this preference share also have a cost? Yes, the rate at which we pay dividend. Right, so we pay dividend. So let's assume that this cost of preference shares is 15%. Do we have any cost on equity? Do we have any cost on equity? What is the rate which is mandatory? What is the rate of dividend which is compulsory that is to be paid to shareholders? There is no such rate. That means cost of equity is nil. There is no cost of equity. Yes or no? So let's say that I am listed company, I pay dividend, I am L&T. On a 1500 rupees stock, I pay 15 rupees dividend. So I pay 1%. So is my cost of equity 1%? Interest cost. See, the logic here is, you start your business and the money that you invest is your equity. Is that correct? So let's say you started your business with 500 CR. Now, if you wouldn't have started your business, you can keep that money in fixed deposit. Right? And then that fixed deposit might give you a return of 10% or 12%. So when you invest that money into your business, though there is no explicit cost, you would say that minimum that I want to earn is 12% here, isn't it? But then if I invest my money into a fixed deposit, it's a safe investment. But when I am investing my money into equity of this company, it is not such a safe investment. So I would probably want more than 12%. Are you following the intuition? That there is no explicit cost which is attached to equity shares, but there is an implicit cost. If a company does not earn that much, if a company does not give that return to the shareholders, shareholders would go and invest somewhere else. Which makes sense that if you buy Infosys, and let's say Infosys gives you a return, which is, it pays you a dividend of 3% and capital appreciation is 2% in a year's time. What you would say is that instead of investing into Infosys, if I would have invested into an FD, it would have given me 10%. So with Infosys, since I am investing into equity, I would probably want 12%, 14%, 15%, more than that. Is this making sense? So there is an opportunity cost, there is an implicit cost which is attached with equity. So now my question is, debt was 10%, compared to debt, preference shares were given more return, and there was a logic that in case if there is a default, these people would be paid first. After that, preference share people would be paid. Which means that relatively preference shares are taking more risk and therefore they are being compensated with a higher return. So now these equity guys are the ones who are taking maximum risk in the business, because if something goes wrong, these are the people who would be paid last, isn't it? So the return that they should expect should be greater than 10% and 15%. So how do we calculate that? That's what we want to study today. But on a broader level, I'm simply assuming this to be now 20%. So what is this topic about? This topic is about how do you find out cost of equity, how do you find out cost of preference share, and how do you find out cost of debt. This is one. Now once I have these three costs with me, now I want to do a project with this money. And this project is going to earn me, let's say, a return of 15%. And what we've learned is that this return that we earn is typically called as IRR. So this 1000 CR will earn me 15%, but I want to decide should I accept or should I not accept. So this 15% now should be compared. We need to compare this 15% with what? We need to compare that with cost of capital. But there was one word that I did not attach to cost of capital earlier. That was, I need to compare this with weighted average cost of capital, which is called as WACC. So, what it would mean that my 1000 CR has not come from only one source. Had it been only debt, my cost of capital would have been 10%. It has come from 3 different sources. So what I need to do is I need to calculate a weighted average of these numbers. I need to calculate a weighted average of this cost so that I can compare that cost of capital with this IRR. So how do I do it? I will say my equity is 200 and my total capital is 1000. So what is my weight of equity into my total capital? 20%. Equity 200, total capital 1000. So weight of equity is 20%. Preference share 200, total capital 1000, weight of preference share is 20%. Debt 600, total capital 1000, weight of debt is 60%. So now I have cost, now I have weights. Now I can calculate a weighted average, which would simply be 20 into 20% 4, 15 into 20% 3, 10 into 60% 6, and then I will take a total of all of these, and this would be 13. So my weighted average cost of capital is 13, and since my IRR in this example is more than weighted average cost of capital, my NPV is positive, my decision is to accept. Are we clear with this? So that is the reason why we need weighted average. So please write down the example and then we will start doing each of these costs one by one. Are you done writing? Okay. Now we'll follow the approach in the same fashion. So first we will learn to calculate the cost of equity. Now this cost of equity can be calculated for CFA level 1 in 3 possible ways. Okay. So you first write down all the 3 models, you write down all the 3 formulas. There is a logic behind all 3 of them, but you would be required to remember these formulas. The first one is a legendary model which you might have to use all your life, which is called as CAPM. CAPM is Capital Asset Pricing Model. The next model is dividend yield plus growth. And the third model is bond yield plus risk premium. So CAPM will be calculated as cost of equity, which is denoted by KE at times, is equal to RFR plus, this is fancy word, beta into market risk premium. RFR plus beta into market risk premium. Dividend yield plus growth rate is calculated as D1 divided by P0 plus G. D1 divided by P0 plus G, and bond yield plus risk premium is calculated as YTM of the bond plus the risk premium. Dividend 1 divided by price 0 plus the growth rate. Are you done writing? So let's first understand this one, CAPM. It's a fairly logical model. See what it means is now that we are trying to find out cost of equity of a listed company called XYZ Limited. Okay. We want to find out what should be the cost or what should be the return that shareholder should expect to earn from this equity investment. So we follow a very logical approach. That the first thing that we do is that I want to invest my money into this country. If I decide to choose the most safest investment avenue possible, which one would that be? Government securities. So the yield which is given by government securities, that yield is called as risk-free rate of return, RFR. So let's assume that in India, your RFR is 8.8%. So what we will say is that if I am making an investment, no matter what security it is in India, the lowest that I should expect is 8.8, because this is the safest security which is offering. So if I am investing into a risky security, I should expect more return, so plus. Have you followed this? Now you would say that this 8.8% is given on a fixed income instrument. It's given on a bond. But am I investing on the bond? No, I'm investing into equities. So on an average, how much is the equity market giving more return compared to bonds? How much is the equity market giving more return compared to bonds? So I go on to Sensex and I see that in the last 1 year, what is the rate of return which is given by Sensex? Okay. So let's say that Sensex has given a return of 18.8%. Okay, I have assumed this. So this would be called as return on market. That return on overall market is 18.8%, whereas your RFR is 8.8%. So we will say that market risk premium is 10%. That equity markets have given 10% over and above the risk-free rate of return. Are we clear with this? Equity markets have given 10% over and above the risk-free rate of return. So, plus I also want to earn that extra 10% because I am making my investment into equity, not into bonds. So, plus 10%. This is market risk premium. But the question is that this is the return on Sensex. I am not investing into Sensex. I am investing into security XYZ. So, if the overall equity markets have given extra return of 10%, if my equity security is more riskier than the overall market, I should expect more than 10%. If my equity security is less riskier than the overall market, I should expect less than 10%. So, what I am going to assume now is that risk of market is 1. Okay, I just attached a number to it. The risk of market is 1. If security XYZ, let us say, is more riskier. Okay, so there is a statistical formula through which we can calculate this risk, and we would do it later on. But this risk is, let us say for XYZ is 1 point, okay, let me keep it as 2. That XYZ is 2 times more riskier than the overall market. So what does it mean? That if Sensex increases by 10%, XYZ will increase by 20%. But if Sensex decreases by 5%, XYZ will decrease by 10%. If Sensex decreases by 30%, XYZ will decrease by 60%. So this XYZ is 2 times more volatile than overall Sensex. So compared to a market risk of 1, the risk of XYZ is 2. So if for one risk, entire market is earning 10%, since I am taking 2 risks, I want to earn extra 20%. So market risk premium into beta of the stock. So the cost of equity would be 28.8%. Have you followed the intuition here? That there is a logical derivation, of course, to be honest, there is a mathematical derivation. Okay. This formula is nothing but a equation of a regression. But at this stage, we would try to understand it from a non-mathematical logical way, that minimum that I wanted to earn in this country was 8.8%, but I'm not investing into RFR, I'm investing into risky security. So overall market is given extra 10%, so I want extra 10 because I'm into equity. But my security is 2 times more riskier, so I want double the time of extra return, so into 2. So RFR plus market risk premium into beta is your cost of equity. Are we good?
Which is the more riskier?
XYZ. Oh, compared to market.
Sensex is more risky.
Why? If Sensex moves by 10%, your security XYZ would move by 20%. So since XYZ is more volatile, the riskier security is.
But what is the example?
More unsecured rather than something in other sector where.
Okay. Let's do an example. See, this is your Sensex. I'm going to assume really simple numbers here. And this is your security XYZ. This is day 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, so we'll take data of 9 days. Sensex moved by 10%. This particular security increased by 30%. Then Sensex, we'll start with this number. Then Sensex increased by 15%. This security increased by 45%. So I'm just assuming random numbers. Let me give this as 12. Let me give this as 3. These are the numbers. Now, what I want to do is that I want to see this relationship graphically. Now, looking at these numbers, what do you feel? Which one is more risky? Is it the Sensex which is more risky or XYZ is more risky?
XYZ.
XYZ. Because XYZ is showing substantial amount of variability. So, if I decide to put this in a graph, this is how it is going to look like. That my returns on Sensex are on x-axis and returns on security XYZ are on the y-axis. So a 1% movement in Sensex has been reflected by return on security here on the y-axis. I can decide to have this thing in the form of an equation. Okay, so what equation does it show me? It shows that return on, let me just increase the size of this thing. This is the equation of this particular line. Okay, so on a very simple level, this is your first, for a few of you, this might be your first introduction to what a regression really is. So I would say that my Sensex is the independent variable, return on Sensex. And I am assuming that based on the return on Sensex, the return on XYZ are going to change, which is the dependent variable. So if the Sensex increases by 10%, there is a relationship of 3x. There is a relationship of 3x here, that my return on Now XYZ is going to be 3 into the return on Sensex plus a very small number to adjust for. So what we say is that beta of this security is 3, which is actually the slope of this line. Okay, so in case if you know some calculus, if I use dy by dx of this particular line, if I take a very small point on this line, and if I take dy by dx of that line, that is the beta of this stock. Is this clear? Or if you don't understand this, you don't have to worry. The simple logic here is that if there is a 1% increase here, if there is a 1% increase on x-axis, there would be a 3% increase on y-axis. So if I, from 10, if I take this to 11, let's assume that this is for 10, this is about 22 here. On 11, it would be 25. So the slope of this particular line is 3, therefore the beta is 3. So that is the reason why if I put returns on Sensex on x-axis and return on Sensex on y-axis, then the slope of this line would be, I am repeating my question again. If I put returns on Sensex on x-axis and returns on Sensex on y-axis, yes, but what would be the what would be the slope of this line? It won't be a straight line. See, it would not be. See, it's like this. It's common sense. I am going to put return on Sensex here. Okay, and I am going to put return on Sensex here. So if return on Sensex is 1%, return on Sensex is 1%, return on Sensex is 2%, return on Sensex is 2%. So this is my first point, this is my second point, this is my third point, this is my fourth point. I draw a line, the slope of this line would be 1, isn't it? So if I have to calculate this dy by dx, or dy by dx simply means that when my x increased by 1% from here, the increase in x was 1%, so that I put in denominator. What was the increase in y? Increase in y is also 1%, so the slope of this line is said to be 1. So therefore beta of market is always 1. Beta of market, because beta of market to market, so that's why we say beta of markets. So beta of market is 1. So instead of Sensex, if I have a security which is XYZ, that this 1% increase here resulted into 3% increase here. So from 1 this became 4. This 1% increase on Sensex resulted into 3% increase here. Therefore beta of our XYZ security came out to be 3 or 2. So you might see certain stocks, for example Hero MotoCorp. Okay. So Hero MotoCorp has got a beta of about 0.75. That means it doesn't move. When Sensex moves by 10%, Hero MotoCorp would move only by 7.5%. Right? Whereas certain stocks, for example, if you take beta of DLF, that when Sensex moves by 10%, DLF might move by 12%.
Negative beta can be there?
No.
Negative correlation cannot.
It can be actually. The slope of line can be negative. The slope of line can be negative. That means beta can be negative. But anyways, have you understood the logic? The stock which is more variable, it will have a bigger beta. The stock which is less variable than the Sensex, then it would have a smaller beta which would be less than 1. The beta of market is 1. And if you haven't understood anything out of this, you just need to remember CAPM. Cost of equity is equal to risk-free rate of return plus beta into market risk premium. Market risk premium is calculated as return on market minus risk-free rate of return. Okay, so that suffices our purpose. The second model was dividend yield plus growth rate model, which I call it as common sense model. That you've invested into equity, right? And you decide that how much return do I want to expect out of it. Your return will come from two sources. The first area from your return would come is dividend, and the second area from where your return would come is capital appreciation, right? So that is growth, the rate at which your stock is increasing. So if your stock is at 100 rupee, you expect a dividend of 5%, that means 5 rupee, and you expect that your stock will appreciate by, let us say, 15 rupees. So this is 5% plus growth rate is 15%. So your cost of equity is 20%. Are you clear with the logic? One thing that you have to be really careful with this is that this D1 that we take to find out dividend yield, that means this dividend of 5, this should be next year, not backwards. Okay. Yesterday, if you were there in the class, we were solving few questions. So, if the dividend is 5 rupee for this year and growth rate is 10%, to calculate this dividend yield, you would take a dividend of 5.5%, not 5.
So how do you calculate the price? Because price is not in percentage terms. It's given 10%.
If I tell you that price of a stock is 30, dividend paid last year is 6 and growth rate is 10%. When you want to calculate this cost of equity, if you say 6 divided by 30, which is about 20%, plus 10%, if you say cost of equity is 30%, this would be incorrect. Because this is the dividend which has been paid last year. So you would find out what is the dividend for the coming year. So 6 plus 10% dividend for coming year would be 6.6 divided by 30, which would be 20.2%. Am I correct here? 22%. So your dividend yield is 22% plus this 10%, it would be 32.2%. I'm assuming that you're clear with this. And the last model, that if companies got equity here of, let's say, 1000 CR, companies got debt of 1000 CR. Okay. Now, these bondholders currently in the market are earning 15%. So can I say that this is the bond yield? These bondholders in the market are earning currently 15% per annum. So the rate which a bondholder gets to earn is called as YTM. Is the rate that bondholders earn is called YTM? Yes. So if bondholders are earning 15%, as an equity shareholder I should earn more than 15%. So how much? 15% plus a risk premium, which is the third approach. So I should earn probably 18% or 19%. You don't have to worry about calculation of this risk premium. Are we clear? So I'm again revisiting all the three types of calculation of cost of equity. The first one was CAPM. This was more of a regression model, a graph model, where we said that cost of equity is equal to RFR plus beta into market risk premium. The next one was dividend yield plus growth rate model, where we said D1, not D0, D1 divided by P0 plus growth rate G. And the last one was bond yield plus risk premium. So you find out the YTM on the bond, and to that you add a risk premium.
The dividend for next year should be calculated with plus the growth rate.
Yes. So
But
D1
the dividend is always on the face value. So how would that actually be? The growth of the.
That's one of the common misconceptions that we have in India, and that is also one of the reason why SEBI is trying to do away with the practice of calculating dividend as a face value. See, what happens is, for example, if you go on to the NLD annual report, okay, they would say that we have given a dividend of 1400% this year. Okay, 1400% means 14. No, they would say we've given a dividend of 700% this year. Now, as an investor, what you might feel is that 700% is the return that you've earned. But what it actually means is that their face value is 2 rupee and they've given a dividend of 14 rupees. So, we do not calculate dividend as a percentage to face value. We calculate dividend using various techniques. So that we learned when we did dividend, that based on various parameters, how much do I want to invest, I would decide what dividend is to be given. Once this dividend is given, we disclose it as a ratio to our face value. Okay, so it doesn't mean that if L&T's face value tomorrow becomes 1 rupee, it doesn't mean that amount of dividend will decrease or increase. It simply means that they would calculate dividend based on their regular fashion and then they will disclose it as a ratio to face value. So that's got nothing to do with face value. Are we good to move on now? So now let us go on to the second part of calculation of cost, which is cost of preference share. Now this cost of preference share can be calculated very easily. It would be calculated as preference dividend divided by market price of preference share. That's it. Preference dividend divided by market price of preference share. So what does it mean? There is a preference share which has got face value of 100 rupees. It has got market value of 120. It has given a preference dividend of 12% this year. Can you tell me the amount of preference dividend? Will it be 12 or will it be 14.4? It will be 12. Preference dividend is always calculated as a ratio to face value. But what is it that a preference shareholder is earning? Is he earning 10% or is he earning 12%? Preference shareholder is earning 10% because he currently owns a security which is worth 120. If he wants to sell, he can sell it at 120 in the market. But how much is he earning on that? He is earning 12 rupees. So he gets to earn 12 as a ratio to 120, which is 10%. So be very careful here that in the denominator we would use the market price of the share, not the face value of the share. So had the market price been 240, then your cost of preference shares would have been 5%, which is 12 divided by 240. Are we good to move on? Anyone with doubts? Please stop me if you are not clear. Now the last one, which is cost of debt. So we'll do an example. There is a capital structure, equity 100, debt 100. Okay. Cost of debt is 20%. This is the balance sheet of that company. We will make an income statement. We will say sales 200 minus operating expenses. In fact, the best way to do it is to take two firms, firm A and firm B. Firm A is equity 100, debt 100, whereas firm B is only equity 200. Firm A has got total capital of 200, equity of 100, debt of 100. Firm B has got total capital of 200, which is entirely equity. So both of them have sales of 200, 200, operating expense of 100, 100. So their EBIT is 100 and 100. Interest cost for firm A would be 20. Interest for firm B is 0. So your EBT 80, EBT 100. Let's assume a tax rate of 30%. So this is 24. That means your earning after taxes is 56. And this would be 30, so this would be 70. Now see, the only difference between the cost structure of firm A and firm B is what? Interest. The amount of interest is 20. But the difference in net profit is how much? Difference in net profit is 14. So though there is a difference of cost of 20, the difference in net profit is only 14. And why is that? Taxes. That when I am paying 20 of interest, it's reducing my taxes here. So I am paying lesser taxes of 6. So my effective cost of interest is 14 here. And 14 as a ratio to my debt of 100. 14 divided by 100 is how much? 14%. So instead of doing all this, we could have simply calculated this. Cost of debt is equal to 20% into 1 minus tax rate. Okay. So if your tax rate is 30%, your effective cost of interest is going to be 20% into 70%, which would be 14%. Are you clear? This is your effective cost of interest. Have you done this before? So if I tell you that your cost of interest is 30% and your tax rate is 30%, what is your effective cost of interest? 21%. How did you calculate? 30 into 1 minus t. So 30 into 70%, that would give you 21%. If I tell you that your cost of debt is 20%, your tax rate is 40%. 12%. So you said 20 into 60%. Are you clear? So now we've learned to calculate all the three costs. Now learn to calculate weighted average cost of capital. This is your capital structure. Equity, preference share capital, debt. Equity is 300, preference share capital 300, debt is 400. Risk-free rate in the country is 10%. Return on overall market is 15%. Beta of the stock is 2. Interest rate is 12%. Tax rate is 50%. Preference dividend is 15 rupees. Market price of preference shares, market price of preference share is 120 rupees. Calculate weighted average cost of capital. Yes, 50. So if you get this right, you know what is required in this topic. How much? 12.37. Oh, okay. Give me a weighted average cost of capital. 1.4. It's logical. None of your cost is here greater than 20%. So weighted average would be lesser than that. 12.15. Okay. We've received one of the answers is 12.15. 12.3 is the second answer that we've received. How much, Vivek? 12.3. Vinay? 18.1. Unlikely. You're not using after tax cost of debt. That's where it's going wrong, I guess. Do you want to do this together? See this carefully. You do the next one. Your first step that you should always do is calculate their weights. Now in this case it's really simple. Total capital is 1000. So this is 30%. This is 30%. And this is 40%. So the total of your capital is 100%. Now we will start calculating their cost. Okay, so let's start with cost of debt. It's the easiest one to do. Interest rate is 12%, tax rate is 50%. So 12 into 1 minus t, that means 12 into 50%, cost of debt is 6%. So your cost of debt here is 6%. Now calculate cost of preference share. Dividend divided by market price of share. Dividend is 15, market price of share is 120. 15 divided by 120, 12.5. So your cost of preference share is 12.5%. Cost of equity is to be calculated using CAPM because we have CAPM data here. So risk-free rate plus beta into market risk premium. How much is market risk premium? 5%. 15 minus 10. How much markets have earned over and above risk-free rate of return? 5. 5 into 10. 5 into 2 is 10. 10 plus 10, 20. So cost of equity, 20. Does anyone have any problem up to this? Anything which is not clear? Okay. So once you have this, then what you... Yes, any problem?
Equity, sir.
How much is your RFR? 10%.
Your beta is 2, right? So that
RFR plus beta into market risk premium. So your beta is 2, your market risk premium is 5. 5 into 2, 10 plus 10, 20. 15% is the return on market, 10% is the RFR, 15 minus 10, 5. Market risk premium is how much extra markets have given over and above RFR. So 15% minus 10%, 5% is your RFR. 5% is your market risk premium. 15 divided by 120. Preference dividend 15 divided by 120 is the market price of preference shares. This is your cost of debt. 12% into 1 minus t. 12% into 50%. Is this clear? Yes, please ask questions. Anything not clear? Now after this you simply need to calculate weighted average. 20 into 30% is 6. This would be 3.75 and this would be 2.4 and a total of all of these would be 12.15. Are we clear with this? Yes, no? That is interest into 1 minus t. So 12 into 1 minus 50%, which would be 6%. Okay.